Hello, my name is Abhishek Singhal, and I lead the passives and product initiatives for Aditya Birla Sun Life Mutual Fund. Today, we are going to be talking about some of the key ratios that you should know about when investing in or evaluating mutual funds. The first ratio is called beta. Beta of a mutual fund is also a measure of its relative risk to its benchmark. It's a measure of volatility of a mutual fund compared to its benchmark, which by definition means that if you have a beta of 1, the mutual fund will actually move just the same amount as the underlying index. Beta is a measure of relative risk, but it's not an indicator of the inherent risk of the fund. Let's just understand it with an example. Let's have a look at the data for Aditya Birla Sun Life Digital India Fund. The fund is benchmarked against S&P BSE IT Total Return Index. The beta of this fund is 0.84, as you can see from the chart. If the beta is less than 1, then the fund is perceived to be less risky than the index itself. In this example, if ABSL Digital India Fund has a beta of 0.84, it means that it is less risky than the IT index that it is tracking. It also means that if the index falls by 1%, ABSL Digital India Fund should fall by only 0.84% and vice versa. The second ratio that we are talking about is alpha. Alpha is the excess return of a mutual fund over its benchmark on a risk adjusted basis. Now, what does this mean? The risk free return is the maximum return one can get without taking any risk. For example, a treasury bill issued by the government of India. So mathematically, alpha is equal to the mutual fund's return minus the risk free return minus the benchmark return over risk free return into beta. Now, it sounds complex. Let's take it with an example of Aditya Birla Sun Life Digital India Fund again. In this case, the 3-year fund return is about 30.42 percentage points. The 3-year benchmark return is about 29.85 percentage points. The beta of the fund is 0.84, as we just saw, and the risk-free return measured for the 364-day T-bill is 3.73 percentage points. So it means the alpha generated by Aditya Birla Sun Life Digital India Fund is 30.42 minus 3.73, which gives you 26.79, and subtract from that 0.84 into 29.85 minus 3.73, which gives you 21.94. The net alpha generated is 26.69 minus 21.94, which is equal to 4.74 percentage points. So therefore, alpha is not just the difference between between the benchmark and the fund's performance, which is the common perception. If that were true, alpha would have been only 0.57 percentage points, which is 30.42 minus 29.85. But rather the alpha is 4.74%. So where is the difference of 4.17 coming from? The fund has managed to generate 30.42 percentage points compared to the index 29.85, while managing to stay less risky or less volatile also. You remember, because of the beta of 0.84. Hence, the fund is being rewarded for its lower volatility. To conclude, alpha is the excess return of the fund over its benchmark returns and subtracting for the risk adjusted feature as well. The fund is rewarded if the returns are generated by keeping a lower risk profile and penalized if the risk profile is more volatile. The next ratio that we are talking about is an important one. It's called Sharpe ratio. The Sharpe ratio measures the risk adjusted performance. It tells an investor whether the investment return is due to wise investment decisions or because of taking excess risk or undue risk. The measurement is very useful because while one's portfolio or security may generate higher returns than peers, it is only a good investment if those higher returns do not come at a cost of much higher risk also. So the Sharpe ratio is calculated by subtracting the risk-free rate of return from the rate of return of an investment and dividing the result by the investment's standard deviation. In other words, dividing by the risk of that fund. So Sharpe ratio is equal to mutual fund return minus risk-free return divided by standard deviation. Let's take an example of Aditya Birla Sun Life Flexi Cap Equity Fund. The 3-year fund return is 14.34 percentage points. The standard deviation of this fund is 23.82 percentage. The risk-free return of the fund is 3.73%. It is measured by the 364-day T-bill. So the Sharpe ratio becomes 14.34 minus 3.73 divided by 23.82, which gives us 0.44. It implies that the fund has generated 0.44 units of return over and above the risk-free return for every 1 unit of risk undertaken. Therefore, higher the Sharpe ratio, better it is for the fund, as we all want higher returns when we take that incremental extra risk. The next ratio is an extension of the Sharpe ratio. It's called the Sortino ratio. The Sortino ratio is similar to Sharpe ratio in the fact that it measures risk only or risk adjusted return only, but it takes into account only the downside deviation for the denominator instead of the standard deviation. Standard deviation does not make a distinction between upward and downward volatility, which means if markets go up, there is an upside volatility. If markets are going down, there is a downside volatility. The distinction is important since the upward volatility is not going to lead to losses, but the downside is. It actually then indicates the excess returns given over the benchmark or the average. It's the downward volatility which is leading to losses, and hence this ratio tries to capture only the downward volatility. Higher Sortino ratio indicates lower risk and higher returns. Let's have an example of Aditya Birla Sun Life Balance Advantage Fund, because this fund typically tries to look at limiting your downside while giving you participation in the market. The Sortino ratio of this fund is 0.66. So effectively, the Sortino ratio takes forward the concept of Sharpe ratio, and by penalizing the funds on underperformance and providing more appropriate fund evaluation during markets which are full of volatility. The last ratio that we are talking about, a very important one, is the expense ratio. The expense ratio is expressed in the form of a percentage, and it indicates the operational cost involved in the management of the fund. The amount collected as expense ratio goes towards cost as legal fees, administration and management cost, advertising and marketing expenses, etc. For example, if one has invested 100,000 rupees in a fund with an expense ratio of 1.5%, then the person is paying 1,500 rupees every year for managing that money. In other words, if the fund earns, let's say 10%, it is paying out 1.5% as an expense ratio. It means that 8.5% will be the net return to the investor. Just a back of the envelope calculation. So the fund NAVs which are reported are already net asset value, which it means that they are reported net of fees and expenses already. You do not need to subtract expense ratio again from that NAV. Since the expense ratio is charged on a regular basis, a high expense ratio over a longer term may actually significantly eat into your returns because of the power of compounding. Different funds have different expense ratios, but SEBI has stipulated an upper limit on all funds to the extent of what they can charge as expense ratio. Equity funds can charge a maximum of 2.25%, while debt funds can charge 2% per annum as their expense ratio. The maximum permissible limit of the expense ratio depends on the AUM of the fund. AUM is assets under management. Let's take it with an example. Assuming that an equity fund X is launched recently and raises 1,600 crores of AUM. For the table given hereby, the upper limit for the total expense ratio to be charged is 1.75%. But assuming that the fund has a TER or total expense ratio of 1.7 post allotment of units, Over the 5-year period, the fund adds another 5,000 crores of AUM, either by market action or by new sales. Now, at 6,600 odd crores of AUM, the expense ratio permissible as per the SEBI guidelines now becomes 1.5%. So the total expense ratio, because of the tiered structure, as you can see in the table, has now come down from 1.7% to 1.5%. These are economies of scale which are coming to you as an investor in a mutual fund scheme that is growing. I hope this quick summary on various ratios will help you make better choices for your portfolios and generate much better results. Thank you for listening in. And in the meanwhile, I wish for you and for your family to stay safe and healthy. See you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.